So we're going to continue on talking about chapter 4 today. Just kind of a little preview. So we'll do a little bit of review. That table from the previous class. Remember our exempt versus non-exempt, post-tax versus pre-tax, and how those affect our taxable base. Then we're going to spend a lot of time looking at the W-4 form, which is a form that employees fill out. They fill it out when they first get started with a job, when they're first hired, but they may fill out updated ones as their employment progresses, and we'll talk about the situations under which somebody might want to fill out a new W-4. We're going to go through that in a lot of detail, get you familiar with what's on that. I'm sure some of you have already filled out W-4s in your life. If you've had a job before, you've filled one out, but we're going to go through and look at it in a lot of detail. And then if we have time, we will start looking at some of the different calculation methods for income tax withholding. These two methods, we have a wage bracket method and a percentage method. Wage bracket method is a little bit simpler. We just use a table. We have to determine certain factors that go into that we then use and apply to that table to kind of triangulate and find the appropriate withholding. This is the easiest method, using a table, because like I said, there's really no calculation involved. You just find the appropriate number based on the information that you have, based on the inputs. But we can't always use that wage bracket method. Sometimes we have to use what's called the percentage method, and that one does involve some calculations. So if we've got time, we'll, after going through the W-4 and everything, we'll start looking at those. We are going to, on Thursday, we'll get more in depth on those calculations, and we'll do some practice problems as well. I think you'll find it's kind of fun once you get it down. It can be a little bit frustrating at first trying to get all the steps down, but once you do, it's kind of fun to do that work. So hopefully you ultimately enjoy it. I'm going to start out today with just a short little video here about how we started paying income tax, both withholding and just ultimately the income tax. So it goes into a little bit of the history. I'll talk a little bit more about some of the specific history as well, but it's just like 5 or 6 minutes here.
Hey, so how did you feel when you received your first paycheck? I was pretty excited, I'll be honest. I worked for weeks and weeks in there in a sealed envelope with my very first hard-earned compensation, and I had so many plans about what I was going to do with the money. But those hopes were brutally dashed the moment I read the bottom line. But by the time the money actually got to me, it had been sliced like a pizza, an alphabet soup of government agencies, each got their cut before I did. But what are taxes anyway? How do they work, and how did we end up with this present system? First things first, the basic idea of taxation is pretty simple. There's some sort of state or similar authority that imposes a levy on an individual or a legal entity, like a corporation or something. If you can't pay, then you can be charged with a crime. This is a very old concept. It dates back as far as Mesopotamia and Egypt's old kingdom. Nowadays, the taxman's not going to beat the crap out of you for being late, but the system is way, way more complicated. In the United States, the taxes you pay vary from person to person, from company to company, from check to check, and then from state to state. However, most people do have to pay the federal income tax. And the U.S. tax system is huge, complex, doesn't even begin to describe it. A better word would be Byzantine, which I looked up earlier. In 1913, Congress passed the 16th Amendment, and the 16th Amendment says this specifically: the Congress shall have power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states and without regard to any census or enumeration. Okay, let's be honest. While most folks in the U.S. only think about taxes when April approaches, the process really begins when you start a new job. You and your employer agree on your compensation or before tax income. Next thing you do is fill out a form called a W-4, and it determines how much income tax your employer will withhold from each check. Why do they do this? Good question. Employers are required by law to withhold income tax and deposit the money in a Federal Reserve Bank. And this is how the federal government maintains a steady stream of income while also drawing interest on your tax dollars. Pretty clever, huh? So instead of paying taxes once a year in April, you're actually paying them all year long, every time you get a paycheck. Now, the rules change when you're a freelancer or an independent contractor or you're otherwise self-employed. Nobody's going to withhold income taxes each time you get paid by a client or a customer, so it's up to you to manage what you owe. What's a good way to think of income taxes? Let's think of filing income taxes in April, kind of like settling up with the IRS. All you're doing is figuring out if you paid the right amount of cash. If you pay too much, boom, you get a refund. If you pay too little, boom, you're writing another check. Income tax forms like the 1040 are notoriously confusing, but that's because they're based on a code that's more than 5,000 pages long because somebody thought that would be a good idea. Presidential candidates are always talking about revising the system, but how, right? Well, there are all sorts of potential alternatives, like, for example, this thing called the flat tax. Under a flat tax system, everybody pays the same rate. So proponents of the flat tax system say that it will do away with all the complicated codes and forms. Critics say this system favors the wealthy, and that's not the most controversial idea. There's another one. It's even more controversial than the flat tax, the idea that we should just repeal the 16th Amendment altogether, abolish income tax. Don't worry about it. In place of income tax, then, they would have a national sales tax. So many countries around the world already levy a national sales tax. You've heard of it before. It's called a value-added tax, or VAT. The difference is that most of these countries also collect income tax. U.S. backers of this plan want to get rid of the IRS and charge a flat 10 to 25% on all retail purchases of new goods and services. So people who are fans of this say that a consumption tax collects revenue from everybody, even illegal residents, tax dodgers, tourists from other countries, etc. Opponents say that it puts an unfair burden on the middle and lower classes who buy a lot of the stuff that will be taxed. They also say it might reduce consumer spending, slowing the economy down. And then they add that in order for it to be fair, it would have to be applied to the purchase of stocks and bonds in addition to consumer goods. Yeah, so it's no secret that taxes are a bitter subject in many countries. And the United States has had at best, a rocky relationship with this issue. The U.S. doesn't just have one of the most complicated tax systems in the world, it also grows more complicated each year. This is a politically charged, divisive issue, but there is one thing that everyone can agree on. The current system is not perfect. So here's a question. What would you change if you were in charge? Let us know in the comments. Go ahead and like and subscribe. Thank you so much.
All right. So just kind of a little bit more history about the income tax. So we had an income tax during the Civil War. Most of a lot of our tax laws have been implemented during times of conflict. So we did have an income tax during the Civil War to fund the military operations during that time. It was repealed afterwards. We didn't have any amendment or anything in the Constitution that actually allowed Congress to levy an income tax. So in 1913, they did ratify what he mentioned there, the 16th Amendment to the Constitution, which did allow Congress to levy taxes on income, and as it said, from whatever source derived. So what we're concerned with here, also, so we didn't have, when it started out, there was not any withholding. So people would file their income tax form, and that's when they would pay their tax. So once a year, they would pay that tax. At first, it was a pretty low tax rate, and it really only applied to, it didn't apply to absolutely everybody. Like it does today. So it was a little bit more simple system, but it did grow more complex. And during World War II, that's when they started to implement income tax withholding, where employers would then be required to collect the income taxes a little bit at a time from employees, and instead of paying it all at the end of the year or paying it themselves throughout the year, they would have those amounts withheld. Makes it a lot easier for the government to actually collect income taxes. It also means that the federal government has a steady stream of income. They're not just waiting for the end of the year to get a big influx of that income. So from our perspective, that's what we're calculating here. That's what we're figuring out, is how do we appropriately calculate the amount of withholding for each employee that's going to be sent off to the federal government. And it becomes complex because what we're trying to do ultimately is match up the amounts that's withheld throughout the year through each paycheck, get that as close to possible to the amount that's actually owed for the year when the individual files their income tax form. So it mentioned that that's kind of like settling up with the government. It's like a reconciliation that individuals do. So they compare what's been withheld, what they've already paid, with what they ultimately owe. And the reason that the withholding can be complex is because that whole process is complex. Taxes are complex. And arriving at the correct number, or at least as close as possible to that correct number, is difficult, almost impossible in most situations, but we want to get as close as possible. It's very rare that people will end up owing on their 1040 exactly what they paid in from their withholding, but the ideal is that we get as close as possible to that. And in order to get as close as possible to that, employees have to fill out this W-4 form that we're going to go through in detail. And that W-4 form is designed to get the employee as close as possible to that number that they're ultimately going to owe for the end of the year. Just a little bit of review, though. If you recall, so this table that we looked at, I'm not going to draw it up here again, but it's there on the agenda. So remember, we've got these one of the factors that we need to know in order to accurately calculate withholding is what our base is, what our appropriate tax base is in order to apply the rate that we're going to use to get to that tax number. Now, this is done every single pay period, and it's individualized for every single employee. But to arrive at that base, we start with these gross wages, which we calculated what those gross wages are in Chapter 2. It may include tips that the employee has reported. It may include bonuses that they've received. It may include all types of different compensation. It may be calculated on a salary basis. It may be calculated on an hourly basis, may be calculated on a piecemeal basis, right? And we've got those requirements, those minimums that we have to abide by. If there was overtime, that employee would have had to have been paid 1.5 times their regular rate, or if they were on a fluctuating work week, remember that nightmare? We did all of that calculation, right, to figure out what those gross wages were. But we don't stop there. If the employer provides benefits, then the value of certain benefits may have to be added to the gross wages before we can figure out what that base is. So we start with those calculations of the actual cash that was received. But to that amount, we may have to add the fair market value of certain fringe benefits. Remember those fringe benefits that the employer provided, things like that gym membership that we talked about? That would be one of those fringe benefits that is taxable to the employee. So we have to determine which of those fringe benefits that the employer paid for are taxable, and we have to take the value of the taxable fringe benefits and add it to the gross wages. This is, again, before we get to our base, before we do the tax calculation, we've got to take these steps. So the fair market value of fringe benefits that are paid by the employer, taxable, have to be added to that base. If they were non-taxable fringe benefits, those things like the meals that are provided for the employer's convenience, that sort of stuff, we're not going to add that because it's not taxable, right? We're just going to add the value of those taxable fringe benefits. And then what we have to do is we have to go over here and look at the employee paid fringe benefits. So things like, did the employee pay for health insurance? Did they contribute to their 401k plan? Amounts that the employee paid for that are pre-tax, we're going to then subtract the value of those benefits from our gross wages. So we're adding the fair market value of employer paid fringe benefits that are taxable, but we're subtracting the value of employee paid fringe benefits that are not taxable. If it's an employee benefit that is subtracted from the employee pay, but is subtracted after tax, we're not going to subtract it at this point. Right now, we want to just arrive at what our taxable base is. Okay, so the amount that we are actually going to be taxing. And these are the amounts that affect how much is being taxed. The taxable employer-provided fringe benefits, so up here in this quadrant, and then we're going to subtract any pre-tax employee-paid fringe benefits. So again, the examples of those, like I said, the gym membership that the employer paid for, if it's off premises, would be an example. If the employer is providing, if they're paying for tuition that's over and above that $5,250 every year, that would be considered a taxable fringe benefit, the amount that's over the $5,250. Some things that would not be included in that, if the employer is paying for some of the health insurance, that would then be a non-taxable, so it's not added to the taxable wages, or a non-taxable fringe benefit that's not added to the taxable wages. Employer contributions to retirement plans, so that would also be an employer-provided fringe benefit, but that would fall in the non-taxable category. So any of those fringe benefits that are taxable, so everything up here in this category, we're going to add to our gross wages. Anything then that is paid by the employee that is pre-tax, so it is subtracted, it falls into that pre-tax category, that is then going to be subtracted. And again, just to kind of reiterate, these benefits that are post-tax, so something like charitable contributions, like if an employee decides that they want to contribute to United Way and they want to do it through a payroll deduction, that is a post-tax fringe benefit. It's not benefiting the employee, but they're contributing to a charity that they support, but it's going to be post-tax. It is going to be subtracted, but it's not going to be subtracted at this point. We're going to subtract it after we do this calculation. Okay, so that's the order in which we'll start with those gross wages, add taxable fringe benefits that are paid by the employer, subtract pre-tax fringe benefits that the employee pays to arrive at our taxable base. Okay, so that's how we get to this number here. And this is one of the factors that we are going to need. Okay, this is something, so this is why I say you've got to do this every single pay period, because this could change every pay period, this could change every pay period, this could change every pay period, so this could change every pay period, right? So it's got to be done on it might be standard if you have a salaried employee that just has, that those are flat amounts every pay period, then it might not change. But for each employee, that's going to be a different amount. Okay, so just kind of does anybody have any other questions about that whole concept of the pre-tax and the taxable fringe benefits? Mm-hmm. We will. Yep. I've got I've got lots of, we'll probably start more next on Thursday doing some practice problems. I've got a whole list of practice problems for us to go through. So let's take a look then. And this was just kind of a reminder of examples. Exempt payments, those are on the PowerPoints. Pre-tax benefits, those items that are in cafeteria plans, retirement contributions. And just to remember that retirement contributions are kind of special because when we're figuring out our taxable base for income tax purposes, we would subtract retirement contributions. So those pre-tax fringe benefits that are employee paid. But when we're calculating Social Security and Medicare tax, we don't subtract them. Okay, so that's why I made a note here. Pre-tax for income tax, not pre-tax for FICA. Okay. All right, so let's take a look at the W-4 form.